Welcome back to another monthly update of my dividend growth portfolio, and you can see that right now you can see my monthly updates across the board from my investments, and I update this at the first of the month every single month. And on 12/1 December 1st of 2022, we had $43,038, and then today we have 37,162 as of this month. We had a bad month in December, but you can see generally over time the trend is heading in the right direction, and hopefully next year we're able to get this above $50,000, $60,000. That would be really nice. Furthermore, we're going to talk in this video my whole portfolio. We're going to talk about the 4 growth stocks. We're going to talk primarily about the 22 holdings in general, which includes the 18 dividend growth portfolio stocks. So we're going to talk about those in this video, and my currently updated weighting in my growth portfolio with my Fidelity account, which currently has 37,000, is listed right here. You can see this is the new updated pie, which reflects the increase to Amazon. I will make an updated video with Amazon, how I bought another 100 shares just recently, but overall, this is what it looks like, my balance, my holdings, and in my next video, I'm going to give an update on my performance, because this reflects as of the end of November. We'll see where we finished out throughout the end of the year, and talk about how I did so. So it's going to be a fun one. If you haven't checked me out before, if you haven't seen me already, this is how I invest, this is how I go throughout 2022, and I'll be displaying all of my balances and all my performance throughout 2023, so stay tuned, it's going to be a fun one. Without further ado, let's go ahead and get started by diving into the growth portfolio, and we'll go over this very briefly for the 4 companies that I own and why I own all 4 of these stocks. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Welcome back, and let's go ahead and get started with number 1, Salesforce. Salesforce is a software as a service, or a SaaS business, which has currently gone down a dramatic amount. In 2022, if you look at the last 1 year, they've went down 48%, which is pretty detrimental considering it's a company that's increasing its performance not only by the year, but by the quarter. If you look on a quarterly basis, you can see the revenue hits record after record after record every single quarter, and on an annual basis, because their free cash flow is a little bit choppy by the quarter, on an annual basis, they're generally trending in the right direction, and this includes free cash flow and free cash flow per share, which factors in dilution, and overall, this company, in my opinion, all the metrics are going in the right direction. When you look at this annual chart, what do you see? You see generally all these metrics going up and to the right, all the way across the board. However, even though the revenue continues to skyrocket for this company, the share price is only going in one direction, and that's down. When you look on a 5-year chart, this company has just gone to the floor, and so I'm buying it aggressively at these prices. Same thing for my number 2 that I want to talk about, which I haven't reflected these percentages, but my number 2 position, based on the updated one that we have today, is Amazon, currently sitting at 27% out of the 4. If we go to Amazon, you can see a very similar story. Generally speaking, the revenue is going in the right direction. And the funny thing is, this only factors in a reasonable amount of the growth because this doesn't factor in FX headwinds, because foreign exchange has really make this company's revenue look a lot lower than what it actually would be if we didn't have interest rate and dollar value changes. So 127 billion still represents almost 15% growth year over year as of the most recent quarter, and free cash flow has gone negative in the last several quarters, and that's why this company's plummeted. Because just like CRM, just like Salesforce, this company's went down a bunch, and I just bought another 100 shares of this company. Now, if you look on a 5-year chart, Amazon is one of the largest businesses and most reliable on the planet, and its all-time high was in the 190 range. It was around 188, I think was the exact amount. And I bought my first shares of these company around 130. I then bought my next 100 shares about 100. I think it was like 107 or something like that. And then I bought my next 100, which is where we're at now, at $83 a share, which is just insane to think about. And when you look over a 5-year basis, you can see that the company has barely even went up at all over the last half decade, which is shocking considering it's Amazon. So now's the time where I want to be buying it. Next up, if we go over to my number 3 out of this 4 position, its 23.8% is made up of CROX, or Croc stock. And Crocs is funny because this didn't intend to be one of my larger positions, but it's just frankly grown into that size. If you look over the last 1 or 2 year chart, I initially bought my position, and actually my whole position, at $76 a share. So around here where my mouse is at. And since then, it has gone higher and higher and higher in a time where the market has generally gone lower and lower. If you look just over the last 6 months, because you can see 6 months ago, it's had very good performance, 100% return just over the last 6 months. Now, the funny thing is, if you look right here, 3 months ago, this is right around the same share price that I bought at. It's went up 50% just in the last 3 months. I'm currently up 40-something percent on my holding, being at $76. And this is one that's simply a valuation play. The growth story from Hey Dudes is underpriced, in my opinion. And investors are bidding the stock down at an 8 forward PE just because this company has a lot of debt, but it's going to be rapidly coming down. As we can see here, every quarter they're paying back $100 million plus of that $2 billion debt. So the reason to bid down this company is going to get lower and lower by the quarter, in my opinion. So that one's doing very well, and I expect it to continue to do so. Speaking of valuation plays, Google is one that I'm mostly buying because of a valuation play. They still have over $100 billion of net cash on the balance sheet, as we can see right here in the most recent quarter, and the company is starting to finally buy back shares in a big way, as you can see over the last several quarters, especially when you highlight the most recent right here. You can see that it's going down in a pretty dramatic way, and I expect this to not only continue, I actually expect it to increase as they use this big cash pile to buy back even more and more shares. Furthermore, profitability has not been hurt nearly as bad as investors are pricing it downwards, because the funny thing is right here you can see profitability year over year is down 14%. However, the stock is down a lot more than 14%. It's almost down 40%, and so investors are really fleeing out the door for this company, when in my opinion they shouldn't be. And of course, that top line revenue is still growing as well to almost a new record with 6% growth in the most recent quarter. Now that wraps up the growth portfolio. Let's go ahead and do the dividend growth portfolio, which many of you are watching. So let's go ahead and get started with that. And we'll start with number 1, WP Carey. And this goes hand in hand with Realty Income, currently sitting at number 1 and number 2 positions in the portfolio. These two are powerhouses in the real estate investment trust space. These are REITs, R-E-I-T, Real Estate Investment Trust, and these suckers have incredibly high yields. WP Carey, as of right now, says it has 5.4% according to this brokerage. And if you look at Realty Income, it has a very similar 4.66%, which is much higher than the average weighting in the market. And these companies are just powerhouses in terms of their top line revenue, their bottom line profitability, their lean business models. I've made many videos about them, including my highest watch video of all time. Realty Income has like almost 40,000 views now, so check that out if you want to see that. But generally speaking, both of these companies across the board are headed in the right direction, and I believe no matter what happens with interest rates, the economy, generally speaking, these companies are going to go up. In my opinion, do your own research, but these are why these are the big powerhouse in the portfolio. Lockheed Martin is one that continues to surprise me. You know, it's at all-time highs. It's at almost $500 a share, and it's easy to want to look at that and just want to sell out, and part of me has the same thought process. I just want to look at that and go, man, now's the time to sell out. It's went up so much. And while I might consider lowering my position, it's gone what I consider to be fair value. It still only has a forward PE of 17.95, about an 18 forward PE, and this company continues to increase revenue. And from a profitability standpoint, it's generally trending in the right direction as well. Year over year, it's up 68% in the most recent quarter, but even generally over the long term, which is what we care about as investors, profitability is going in the right direction. The dividend's growing, the profitability is growing, and it's one that I really like because they have the number 1 most important customer in the world, the United States government. They practically own and run our Air Force in terms of their aircraft. JP Morgan Chase, one that I just lowered a tiny bit, they've gone up quite a bit in this most recent year, and they're starting to perform a lot better, and it's one of the biggest banks. In fact, it actually is the biggest bank in the world, and it's what I consider to be the highest quality. So super simple, just an easy financials play, has a decent dividend yield of currently right at 3%, and it's one that I think will raise that dividend and bounce back a lot when the economy does. And honestly, no matter where interest rates go, JP Morgan can find ways to make money either way off of customer deposits, off of loans outstanding that they have, and then of course their investments into bonds, equities, commodities, and the like. So that's why I like JP Morgan, and this leads me to Visa. Visa is one that I just consistently see a profitable company, because I always like to mention, and I know this might sound repetitive if you've been watching me for a long time, but it's so easy to look at these ratios, these return on capital employed metrics, these gross margins, operating margins, profit margins across the board. These are some of the most impressive you'll find out there in the market. And if you look at each individual one, ROCE is at 29% in the last year. If you look at this on a quarter-over-quarter basis for Visa, you can see that in the most recent quarter, it was 8% just in the last quarter. Gross margin is generally in the 80s. You can see operating margin is generally in the 65 range or so, and profit margin is 50% plus, which is just crazy to see. And you can see that's how they're able to raise those dividends, lower those shares outstanding, and just generally over time just become a better and better business. And it's one that still has a lot of runway for growth, in my opinion, as the younger generations use credit cards a lot more than older. Now you can see Avgo, which is Broadcom, has gone down a lot in share price. Let's go ahead and look. Over the last year, AVGO stock has gone down a lot, and this used to be my biggest holding in this dividend growth portfolio. It's only down 16%, which isn't a horrible amount considering what 2022 looked like, but generally speaking, this company has recovered a lot, and that's because they're currently growing revenue in a huge way. You can see this is not annual numbers, this is quarterly, and this is from both a hardware and a software business. They have it kind of split into both, and the reason they're growing this revenue so fast is from acquisitions and mergers that they've had within the most recent years, and this is generally just exploding the revenue, still growing 20% year over year, and profitability, well, you guessed it, doing a similar metric. Now, if you look at the shares outstanding, they have gone up in the most recent quarter a little bit, but not anywhere what you would expect, only down 0.2% actually within the last year. And this company still has a lot of runway for growth, and they have a track record of growing that dividend 39% on a 10-year compounded rate. 39%. It's very rare to see a company grow their dividend this speed, this long, for this fast. I think that they're going to continue to raise this dividend not only in 2022, but moving forward, they'll likely continue to do so, and they still have a juicy 3.3% dividend yield, which is awesome to see. Now, if you look back into the dividend growth portfolio, next you see Whirlpool, and this is one that generally speaking, a lot of investors just ignore. It's one that they don't care about, it's one that they don't like, and I like this company because of the return capital that they have to shareholders. Right now, if you buy the company and they maintain their dividend, you'll get 5%. Now remember, this company has gone down a lot, almost 40% within the last year, and that makes share buyback opportunities skyrocket. Within the last year, they have bought back 12% of their business. I'm going to repeat it because of how crazy that is. They've bought back 12% of their entire company just within the last year. That is something you do not see every day. If this was half of that, if this company had bought back 6% of their entire stock, this would be impressive if it was half. The fact that it's 12% plus within the last 1 year, I mean, it's hard to even put in the words. If you're a long-term stock market investor and you know a lot about fundamentals and shares outstanding, then you can just realize how insanely fast that is. Just 1 year ago, go back to the most recent quarter a year ago, they had 62 million shares outstanding, and then they bought back almost 10 million shares of that, now at 54.7. And so on top of that 12% buyback, the ownership increasing 12% for you, you also get a 5% dividend yield, which is essentially like getting 17% capital return to you year over year. While the revenue growth is boring, the profitability growth is boring, you can look at return capital and it's one of the best out there. This is the type of business that pretend I had $1 million portfolio and I was retired and I was just focusing on conserving my capital. I was not focused on increasing it, not trying to get the next 10 bag or anything like that, and I was only focused on conserving my wealth. This is the type of company that would be one of the largest positions in my portfolio. Because when you look at the rates at what this company returns capital, it doesn't look very good in the short term. But like most of these businesses, if you look on a 5, 10, or all-time basis, especially when you go to the all-time, they generally trend up in the right direction. And no matter what, you can get a consistent 5% dividend yield that pays you out very steadily. Next up, we have VG Properties, which is very similar to WP Carey and Realty Income. And the one thing I want to mention, the one thing that's unique about this business is that really they only focus on one specific area, which is the Vegas Strip. So basically, if you like WP Carey and you like Realty Income, this is very similar to that. However, they only have properties around the Vegas area for the most part, and it's one that is very, very good performing throughout the last year, because just in the last year they've returned a positive 8%. Considering that the S&P finished down almost 20% in 2022, and this company finished up plus 8%, on top of their 5 to 6% dividend they've averaged throughout the year, that is very impressive performance. They've way outperformed the market in the last year, and they've rightfully done so because their revenue and profitability has grown from their profitable sector that is in the real estate market in Las Vegas, I should say. So these are ones that are very similar, except this one is just in a niche market and one that I've liked. Home Depot, I don't really need to explain, a big brick and mortar retail, and it's one that it's had good performance for so long, and I don't really see people moving away from. While I'm a huge investor in Amazon, it's not a business that I think is going to disrupt it, because you can just see last year in 2022, they grew revenue 14.42%, and this is one that has come down a lot in share price and has already weighted in the factors of the recession, in my opinion, for the most part. Down 23% within the last year, but over time, if we look at the 2, the 5, the 10, and then of course the astounding all-time performance at literally, it's not very often you see this, ladies and gentlemen, going back to the 80s, a 1,000,000% return. Yes, that's a correct number. That's not a typo or not a miscalculation. They've returned literally 1,000,000% since the 80s. It's almost astounding to see. It's hard to even believe it. So literally you could have 10,000x'd your money if you would have put a bunch of money in Home Depot back in the 80s. But generally speaking, this is a company that has done very, very well for a very, very long time. It's one that I think will continue to do good once we get out of this recession. So it's one that I'm going to continue to buy for the time being. Target is one that's very similar, one that typically does good throughout economic booms and economic busts, and they're not very sensitive to the economy. So this is almost like a consumer, or I should say an investor staple, because this is a 3% dividend yield. It's one that consistently grows and trades at a relatively conservative 15 PE. Now, while revenue growth has slowed some, only 3.3% growth year over year, not bad considering we're in a recession. They're still growing revenue growth when many giant companies like this are going down. The profits have gone down. I will mention that. That's why the stock has gone down so much. And that's why you see year over year, you can see the company went down 36%, especially off this huge day. One of the worst days they've ever had. But in the long term, this company will do good. They raise their dividends. They typically grow their profits. And while they do operate with a lot of debt that I don't like on the balance sheet, it is a company that I will think be able to maintain cash flows consistently, and they will be able to buy back shares like they have done so over decades, going back to 2003. They've consistently bought back a lot of this business, and I think that's going to continue pretty much no matter what happens. Now, after Target, if we look on the next on the list, you can see that it goes to Pepsi, which, speaking of defensive investor staples, consumer staples, this is one of the most consistent as consistent gets. And one of these next segments of companies, when you look at these core companies like a Pepsi, like a Kimberly-Clark, a Procter & Gamble, you'll notice many of these businesses coming up are kind of just core holdings that are just going to grow. They're just going to grow. Honestly, you know what? I don't even need to give an explanation. Can you think of a thing that will disrupt Pepsi between all the brands that they own, between Mountain Dew, Lay's chips, Quaker Oats, Doritos, Powerade, Pepsi, all these different brands that PepsiCo has under its umbrella, its portfolio of products, it just continues to grow revenue. Last year, they grew revenue 13%, and the most recent quarter, they're still growing revenue right at about 10% or so within the most recent quarter, and this is one that I expect to grow as the population increases, as people need to consume more beverage and snack products, and basically they continue to buy at other businesses. They've had a long track record of increasing that dividend. They just set the record not too long ago within the most recent years. They now have a 50-plus year raise streak of raising that dividend. I mean, I don't even need to explain it. Look at this dividend increase chart over the last several decades, and it speaks for itself. Forget what I'm saying, forget what you think about the company. Look at this dividend chart. The only way a company can pay out dividends is through profits. No funny money, no little accounting tricks or any type of belief or hope in the stock. This is pure profits. So if you don't have profits, you can increase the dividend, and this chart speaks for itself. So Pepsi will be and continue to be a core holding, and that leads us to the next stock in the portfolio, which is 3M, which is one I haven't been happy with because they've had very lackluster growth despite inflation going up that typically takes up revenue, and they've gone down 3.6% within the last year. It's not one that I'm happy with, and profitability is tanking 28% within the last year, and it's one that in my opinion has struggled, but I think could bounce back. In the meantime, you'll get a hefty 5% dividend yield, and I've been toying with this one a lot on what to do, so stay tuned. We could see a change in this one. I'm not really sure what I want to do with that, so I'll skip over that one. MO stock, which is Altria Group, is one that I don't think is very exciting. It's kind of a long-term secular downtrend, which I don't like, but they do pretty consistent revenues, especially when you look over the last several years. The revenue has stayed flat since that merger. This didn't sell off a portion of the business. They spun off their other Philip Morris business, which you can see since they spun that off in 2008, revenue has slightly grown, and it's a very slow uptrend. Within the last decade, they've grown revenue 2% compounded, and profitability profitability has seen a similar stance, growing at 9% compounded over the last 10 years, but that honestly is kind of skewed because that goes back to 2011 when they had one of their lowest profitability years. Now, this company is increasing profitability lately, but I'm curious to see how far they can push that moving forward. Because in the most recent quarter, it's actually almost exactly flat, almost identical to what it was a year ago. And while they are buying back shares, while that will make it easier to pay out dividends over time, and it is good for shareholders, now is the perfect time to be buying back shares when it's lower. But the opportunity to be buying back shares in this company is only so exciting when the company is growing their actual fundamental business. And right now, they're not really doing so. They're just returning capital to shareholders. So you can get an amazing 8% dividend yield. And plus, they bought back 2.3% of the shares outstanding within the last year, which is awesome. But it's not a business, the ideal business behind smoking and tobacco products and their winery business that they sold off. It's not one that I typically get very excited about because I think long term, it could be a business that dies out. Kimberly-Clark is one of those, like a Pepsi, it's as stable gets. Whether it's Cottonelle or Huggies or other paper products like paper towels and tissues and diapers and things like that, they're the ones who sell them. And look at this revenue chart. It's not exciting, it's very boring, but it's consistent as consistent gets. If you look at it on an annual chart, it gets even more apparent. It's pretty much staying the same for the last decade and a half, growing pretty much nowhere. 0.7 negative percent returns over the last 10 years in terms of their revenue growth, and their profitability is very similar. If you look over the last 10 years, it's grown 2% compounded, which is not very good at all. And the company over the last year, it stays flat. Just like the business, investors don't even really move the stock around very much. You can see on a 1 year, a 2 year, and a 5-year return performance, it pretty much just stays flat because the business stays flat. The good news is it's consistent. The bad news is it's boring, and that's why I continue to hold it, is because it's consistent. It's more one of those, like anchors. One of those anchors in the portfolio that will help ease out your returns over the long term, and that's actually pretty similar to Procter & Gamble, except they're kind of a long-term compounder because they have a lot more inflation-raising abilities to be able to raise prices from their products like Tide and their Febreze and their other household products that they sell every single day, because generally over the long term, these prices go up. Now, it did go down significantly in 2016 when they changed some of their businesses, but generally speaking, this company is growing. If you look at it on a quarter-over-quarter basis, since they've been increasing this steadily, but it's going to be a low, slow grower. Now, in the meantime, they will continue to raise that dividend, which they have done so for a long time. This is one of the longest term dividend growers in the entire United States stock market, and it's one that I continue to expect to raise that dividend over time. Expect another dividend raise in about 3 or 4 months or so, but in the meantime, it's one that's going to be a long-term compounder, in my opinion. Next, we have McDonald's, one that I've considered selling out of the portfolio this year. I actually haven't publicly disclosed that on the channel. I've thought about removing it from the dividend growth portfolio because it trades at a 26 PE, 33 trailing 12-month PE, and it's one that, in my opinion, is not growing the way you would expect it to. It's actually shrunk revenues 5% year over year, and this is one that I'm going to be honest, I just honestly expect this company to go down in the next year. It's flat. It's down 2% within the last year, despite revenue and profitability going down, and it trades at a rich valuation. Don't be surprised if McDonald's right now trading in the 260 range. Don't be surprised if it goes down to 230, to 220, to 200, maybe even lower than that, depending on where the market goes. But McDonald's is one that's very defensive and very reliable, but it's one that, in my opinion, is trading really rich, which is why it's so far down. Now, Next Era Energy Partners is one I always like to mention, and I mostly just do this for energy diversification play. It's not one that I honestly am a huge fan of, but just simply they raise their dividend consistently. They're growing their business from the renewable energy sector, and you can see this over time how well they grow the business, and the dividend even grows more impressive, not on an annual basis, but on a quarterly basis. They increase that dividend massively, which currently pays out 4.5% just to own it. And then finally, similar to McDonald's, the reason this stock is down so low as a weighting in the portfolio, talking about Coca-Cola, is because the company, let's look at the last year, it's down a little bit. It's actually not even, let me rephrase that. It's not down. It's up 7%. It was down last time I checked it. It's actually up now. So this company hadn't even went down in price, despite the recession fears and the revenue still going up pretty good for now, but I'm not sure how well it will go up in the future. Now, profitability is doing okay, but it's still down 5% year over year, which is what investors like this really look into, and I think it will continue to pay out a hefty dividend. Expect them to raise it very soon if they haven't already, but it's just one that's a staple portfolio. Its 25 forward PE ratio is not one one that I'm super excited about, but it's one that I'm holding for now. We'll see what I do in the long term. Thank you guys so much for watching. Check out all the stuff down below in the description. Sign up for MooMoo if you haven't already so you can invest in stocks like these and you can follow along with me throughout 2023. Thank you guys so much for watching, and I'll catch you all next time.